Surprise! Every single trade you place costs you money even before anything actually happens. Before your analysis plays out, before the price does anything at all, you are already slightly in the negative the moment you open a position. That's not a glitch. That's not your broker doing something shady. That's just the cost of trading. And if you don't understand exactly what those costs are and how they add up, they will quietly and consistently eat into your returns without you ever putting your finger on why your calculations are always off. In this video, we're going to cover the 3 main costs you'll encounter as a forex trader: the spread, the commission, and the swap. By the end of it, you'll know exactly what each one is, how to calculate it in real money terms, and how to think about costs as part of your overall trading approach. Let's start with the spread, because it's the one you'll encounter first and most often. Quick disclaimer, I'm not a financial advisor. Everything is for educational and entertainment purposes only. This is not financial advice. Trading involves significant risk. Always do your own research and only risk what you can afford to lose. The spread is the difference between the bid price and the ask price of a currency pair. And to understand it properly, you need to understand that every currency pair actually has 2 prices at any given moment, not one. The bid price is the price at which the market or your broker will buy the currency from you. In other words, it's the price you get when you sell. The ask price is the price at which the market will sell the currency to you. It's the price you pay when you buy. These 2 prices are pretty much never the same. The ask is always slightly higher than the bid, and the difference between them, that gap, is called the spread. Let me make this concrete. Say Euro USD is quoted at 1.08500 bid and 1.08503 ask. The difference is 0.00003. That's 0.3 pips. That's the spread. When you open a buy trade, you enter at the ask price, the higher one. When you close that trade, you exit at the bid price, the lower one. So from the moment you open, you're already 0.3 pips in the red. The market needs to move 0.3 pips in your favor before you're at break even. On a tight spread pair like Euro USD, 0.3 pips is nothing. It's a completely negligible cost on a trade you're targeting 20 or 30 pips. But on pairs with wider spreads, like exotic pairs, for example, the US dollar against the Turkish lira, the spreads can be 10, 20, even 50 pips or more. On those pairs, the spread becomes a significant portion of your potential profit and has to be factored into your target or entry points. Spreads are also not fixed. They change. Most brokers offer variable spreads that tighten during periods of high liquidity, like the London and New York session overlap, and widen during low liquidity periods, like late Friday afternoon, overnight, or around major news events. During a high-impact news release like the US non-farm payrolls and CPI, spreads on major pairs can temporarily spike to 10 or 20 times their normal size. If you're in a trade during that spike, your position can look significantly worse for a few seconds than it actually is. If you're trying to open a trade right as the news hits, you might get filled at a much worse or much better price than you expected. This is one of the reasons many traders, especially beginners, avoid trading directly around major news events. The spread behavior alone can make the outcome unpredictable regardless of which direction the news pushes the market. Now let's talk about commission. Not all brokers charge a commission. On standard accounts, the broker's income comes entirely from the spread, which is why spreads on standard accounts tend to be wider. On ECN accounts, which we touched on in the broker video, spreads are much tighter, sometimes down to 0 on major pairs, but the broker charges a separate commission per lot, traded to make their money. Commission is usually quoted per round turn, meaning it covers both the opening and closing of a trade, or it's quoted per side, meaning you pay half when you open and half when you close. A typical ECN commission might be something like $7 per standard lot round turn. So if you open and close one standard lot, you pay $7 total in commission. On a mini lot, that's 70 cents. On a micro lot, 7 cents. Now here's how to think about whether an ECN account with commission is better or worse than a standard account with a wider spread. Let's say your broker's standard account has a 2 pip spread on Euro USD. On a standard lot, 1 pip is worth $10. So 2 pips costs you $20 every time you open and close a trade. The same broker's ECN account has a 0.2 pip spread and a $7 round turn commission. The spread cost is $2 plus $7 commission. Total cost, $9 per standard lot. In this example, the ECN account is more than twice as cheap to trade on. For an active trader placing multiple trades a week, that difference compounds significantly over time. This is why it's worth doing the maths on both account types before you decide. Don't just look at the spread headline number, calculate the total round-trip cost, including commission per lot, on the pairs you plan to trade. Then compare. Now let's cover the third cost, swaps. A swap, also called a rollover or overnight rate, is the interest charge or credit you receive for holding a forex position open past the end of the trading day. The daily cutoff is typically 5 p.m. New York time. If your position is still open at that point, a swap is applied to your account. To understand why swaps exist, you need to understand what's happening when you trade a currency pair. When you buy Euro USD, you're simultaneously buying euros and selling dollars. Each of those currencies has an associated interest rate set by its central bank. The European Central Bank sets the rate for the euro. The Federal Reserve sets the rate for the dollar. If the interest rate on the currency you're buying is higher than the rate on the currency you're selling, you receive a positive swap, a small credit to your account. If the rate on the currency you're buying is lower, you pay a negative swap, a small charge. In practice, in the current interest rate environment, most trades on most pairs result in a negative swap, meaning you pay rather than receive. And on some pairs, the swap cost is meaningful, particularly if you're holding positions for multiple days or weeks. Let me give you a rough idea of scale. On a standard lot of Euro USD, a typical negative swap might be somewhere around $3 to $5 per night. That sounds small. But if you're holding a swing trade for 10 days, that's $30 to $50 in swap costs alone, on top of your spread and commission. On a mini lot, it's $3 to $5 total for 10 days, much less significant. But on multiple positions, on multiple pairs, held for extended periods, it adds up. Some brokers also triple the swap on Wednesdays. This is because the forex market settles 2 business days after the trade date. On Wednesday night, the settlement rolls forward over the weekend, which means 3 days of interest get applied in one go. If you're a swing trader, regularly holding through Wednesday, this is worth factoring in. As I mentioned in the broker video, swap-free accounts are available from many brokers for traders who are unable to pay or receive interest. These accounts typically replace the swap with a different kind of fee structure, so it's worth understanding exactly what that structure is before assuming you're getting something for nothing. Now let's zoom out and look at costs as a whole. Costs are not a reason to avoid trading. They're a reason to trade with intention. Every business has costs it has to pay to operate. A restaurant pays for ingredients, rent, staff. A taxi driver pays for fuel, insurance, vehicle maintenance. A trader pays spreads, commission, and swaps. The question isn't whether costs exist, they always do. It's whether your trading generates enough return to cover those costs and still be profitable. Understanding your costs helps you evaluate whether your strategy is genuinely profitable after expenses, and it helps you make smarter decisions about which pairs to trade, which account type to use, and how long to hold positions based on your trading method. A quick practical checklist before we wrap things up. Before you open a live account with any broker, look up the typical spread on the pairs you plan to trade. Calculate the total round-trip cost per lot, including any commission. Check the swap rates for those pairs, particularly if you plan to hold overnight. Find out when the triple swap applies, and factor all of this into your trade planning. Your profit targets should account for costs, not ignore them. The traders who treat costs as invisible until the end of the month and wonder why their account isn't growing the way they expected are the traders who never built the habit of trading with full awareness. Don't be one of them. In the next video, we're going to talk about something that directly connects to everything we've covered so far: how to calculate your risk properly. We're going to go through the exact formula for working out your position size on any trade so that you always know before you click buy or sell exactly how much money is at risk if the trade goes against you. See you in the next one.